A $100 monthly dividend check might not pay your mortgage yet, but it covers your internet, your gym membership, or your phone bill forever. But how much do you actually need to invest to get there? Is it $10,000 or $100,000? In this video, we're breaking down the realistic path to $1,200 a year in passive income. Let's get straight to the math. Earning $100 a month means you need $1,200 a year. The amount you need to invest depends entirely on one thing: the dividend yield. The dividend yield is just the annual dividend per share divided by the stock's price per share, expressed as a percentage. For example, if a stock costs $100 and pays a $3 annual dividend, its yield is 3%. So, to figure out how much you need to invest, you just divide your annual income goal by the dividend yield. If you invest in a portfolio with an average dividend yield of 3%, you'd need $40,000 invested. Now, you might be tempted to chase the highest yields you can find, but hold on. Extremely high yields, say over 8% or 10%, can be a red flag. They often belong to companies in struggling industries or with unstable finances, which could lead to a dividend cut. That's the opposite of what we want. A dividend cut is when a company reduces its dividend payment, which would wreck our passive income stream. So, the key is to find a balance between a decent yield and a safe, reliable company. So, where do you find these reliable dividend payers? Let's talk about a few popular options. First, we have the dividend aristocrats. These are S&P 500 companies that have not just paid, but increased their dividends for at least 25 consecutive years. Think of giants like Coca-Cola, Johnson & Johnson, or Procter & Gamble. Their yields might not be the highest, often in the 2% to 3% range, but they offer incredible stability and a track record of rewarding shareholders. Another great option is real estate investment trusts, or REITs. These companies own and operate income-producing real estate, like apartment buildings, shopping malls, or office towers. By law, they have to pay out at least 90% of their taxable income to shareholders as dividends. This often results in higher yields, typically in the 3% to 5% range. Companies like Realty Income, which famously calls itself the monthly dividend company, are popular choices for income investors. Lastly, you could consider exchange-traded funds, or ETFs, that focus on dividends. Funds like the Schwab U.S. Dividend Equity ETF, ticker SHOD, or the Vanguard High Dividend Yield ETF, ticker VIM, hold a basket of hundreds of dividend-paying stocks. This gives you instant diversification, so you're not putting all your eggs in one basket. It's a fantastic way to build a diversified dividend portfolio with a single purchase. These ETFs often have yields in the 3% to 4% range. Let's build a hypothetical portfolio. Imagine we want to hit our $100 a month goal with a $30,000 investment. This requires an average yield of 4%. We could put $10,000 into a REIT like Realty Income, which might yield around 5%. That's $500 a year. We could put another $10,000 into a dividend ETF like SHOD, yielding about 3.5%. That's another $350 a year. For the final $10,000, we might pick a solid blue chip stock with a 3.5% yield, giving us another $350. Add it all up. 500 plus 350 plus 350 equals $1,200 a year, or exactly $100 a month. The most powerful part of dividend investing is reinvesting. When you get that $100, don't spend it. Reinvest it back into your stocks. This is called a DRIP, or Dividend Reinvestment Plan. Earning $100 a month is just the beginning. Once you hit that, the snowball effect takes over. If you want to see more data-driven breakdowns on how to grow your wealth and master the stock market, make sure to hit the subscribe button and turn on notifications for Finance Access. Don't just work for money, make your money work for you. See you in the next video.